Markets experience periodic episodes where price movements diverge substantially from what standard supply-demand analysis would predict. During these periods, participants often interpret volatility as evidence of manipulation, hidden knowledge, or systematic breakdown. The language used to describe these events reflects this interpretation, terms like attacks, squeezes, and takeovers, that suggest coordinated action by specific entities with privileged information. Understanding what's actually occurring requires separating the mechanical reality of how markets process stress from the narrative frameworks participants use to make sense of price action they find disorienting. When commodity prices show persistent differences across major trading centers, the standard explanation involves temporary logistics constraints or local supply-demand imbalances that arbitrage will soon resolve. This framework treats fragmentation as anomalous, a deviation from normal market behavior that will self-correct. But sustained price divergences reveal something more fundamental. The settlement infrastructure connecting these markets may have degraded in ways that prevent arbitrage from functioning as theory predicts. The significance isn't the absolute price difference. It's what that difference reveals about whether contracts actually represent claims on deliverable commodities or merely financial instruments where physical settlement has become unreliable. When arbitrage fails to close pricing gaps quickly, you're not observing a temporary inefficiency. You're witnessing evidence that the mechanisms meant to keep paper and physical markets aligned aren't working as designed. Price differences between trading centers provide concrete information about settlement system integrity. In properly functioning markets, substantial price gaps create immediate incentives for arbitrage that eliminate the spread within hours or days. Traders buy in cheap markets, arrange physical transport, and sell in expensive markets until prices converge. The persistence of wide spreads indicates this process isn't occurring at scale sufficient to close the gap. Several factors prevent or slow arbitrage, even when price differences appear profitable. Export licensing requirements in producing nations can delay or prevent metal shipments. Capital controls in destination countries can complicate payment settlement. Transportation capacity for international bullion shipments is finite and can become constrained during periods of elevated demand for physical movement. Insurance costs for high-value cargo shipments increase during periods of geopolitical tension or supply chain disruption. But the most significant barrier emerges when doubts arise about whether positions in paper markets can reliably convert to physical metal at stated prices. If participants suspect that delivery requests will face delays, quality disputes, unexpected fees, or outright failure, the apparent arbitrage opportunity carries execution risk that may exceed potential profit. Markets where settlement integrity is questioned see arbitrage volumes decline rather than increase, which allows price spreads to widen further rather than narrowing. The spread itself becomes a diagnostic tool. Narrow, temporary spreads suggest normal logistics friction and currency fluctuations. Wide, persistent spreads signal deeper problems with settlement mechanisms or physical availability. When price differences reach levels that should trigger massive arbitrage flows yet persist anyway, the market is communicating that standard assumptions about convertibility between paper claims and physical delivery no longer hold reliably. Understanding how leverage operates in futures markets reveals why margin adjustments create significant market impact despite appearing as technical modifications. Futures contracts allow participants to control large notional values with relatively small capital deposits. This leverage amplifies both gains and losses, making position holders sensitive to changes in margin requirements that alter how much capital they must commit to maintain positions. When exchanges increase margin requirements, they're raising the cost of maintaining positions without changing the underlying exposure. A trader controlling a position worth several $100,000 suddenly needs to deposit additional tens of thousands in margin to keep that position open. This doesn't reflect a changed view about the asset. It's a mechanical requirement imposed by exchange rule modification. The impact cascades through leveraged participant populations. Those operating near their capital limits face a choice: deposit additional margin or close positions. Many lack ready capital to meet increased requirements, forcing position liquidation regardless of their market views or willingness to hold. This creates selling pressure that stems not from changing fundamental assessments, but from capital constraints interacting with rule changes. The timing and magnitude of margin increases matter substantially. Large increases implemented quickly during low liquidity periods maximize market impact by concentrating forced liquidation into narrow windows when absorption capacity is limited. Gradual increases during high liquidity periods allow participants to adjust without creating cascading effects. The choice of implementation approach reveals whether margin changes serve genuine risk management purposes or aim to engineer specific market outcomes. Exchanges justify margin increases through volatility metrics and risk management frameworks, but the discretionary elements in these frameworks create space for timing adjustments to benefit particular market participants over others. When margins increase during periods of relatively calm trading, it suggests factors beyond pure risk management are influencing the timing decision. Large financial institutions regularly adjust commodity positions across hundreds of instruments based on evolving risk assessments. These adjustments reflect normal portfolio management, regulatory capital optimization, legal liability mitigation, liquidity risk assessment, rather than unique predictive insight about market direction. When these routine adjustments get characterized as institutions fleeing or evacuating positions, it transforms operational risk management into evidence of impending catastrophe. Institutions issue similar guidance across dozens of instruments annually, with most having no subsequent dramatic market impact. The cases that do precede market stress get remembered and amplified, while the majority that don't get forgotten, creating survivorship bias that makes the pattern seem more predictive than outcomes justify. Position reduction recommendations typically serve multiple institutional purposes, documenting that clients were warned if losses materialize, reducing regulatory capital charges from concentrated positions, and managing operational risk around market liquidity. The public generally doesn't see routine position guidance because it's not material information requiring disclosure. It's part of ongoing advisory relationships between institutions and clients managing significant portfolios, requiring active risk management. When one communication gets characterized as a dramatic leak, audiences receive no context about how many similar recommendations the institution issues routinely, making it impossible to assess whether this specific guidance represents unique concern or standard practice. Media coverage that frames position adjustments as insider revelations strips away operational nuance about why institutions issue guidance. Legal liability management, regulatory capital optimization, and liquidity risk mitigation get collapsed into simplified narratives about institutions knowing disaster is imminent. The possibility that institutions might recommend position adjustments for mundane operational reasons rather than unique predictive insight doesn't fit dramatic framing, so it gets omitted. Modern commodity markets operate through layered claim structures, where exchange-traded contracts represent top-level claims theoretically convertible into warehouse receipts for specific bars, which themselves represent claims on physical metal stored in vaults. This layering works smoothly when conversion demand remains modest. The system depends on delivery being rare enough that warehouse inventory capacity never faces meaningful stress. When significant numbers of participants simultaneously attempt converting paper claims into physical holdings, the layering reveals its fragility. Each layer involves intermediaries who may not maintain one-to-one backing for every claim they've issued. Banks offering unallocated accounts often operate on fractional reserve assumptions. Warehouse systems supporting exchange contracts maintain operational flexibility through leasing arrangements. These practices create efficiency during normal conditions, but become problematic when conversion demand spikes. The timing mismatches between when contracts can be exercised and how long conversion actually takes create additional stress. Contractual terms suggest delivery happens within defined timeframes, but operational reality involves scheduling transport, coordinating vault access, completing documentation, and physically moving metal. During elevated delivery activity, these operational steps create queues, where participants demanding immediate settlement discover that immediate stretches to days or weeks. Exchange inventories exist in two categories: eligible stocks, representing metal stored but not currently designated for delivery, and registered stocks with warrants attached, making them available for contract settlement. Only registered metal can satisfy delivery obligations. Converting eligible to registered status requires paperwork and owner consent. It's not automatic or instant. When delivery volumes consume significant portions of registered stocks rapidly, the remaining buffer shrinks, reducing system capacity to absorb additional delivery requests without running critically low. When delivery-driven supply stress emerges, costs distribute unevenly according to participant sophistication and resources. Large financial institutions clearing substantial volumes can net delivery obligations internally, matching client demands against other clients' willingness to deliver. Their scale provides natural hedging that smaller participants lack. These institutional players also maintain established relationships with warehouse operators, transport providers, and metal suppliers that give them priority access during constrained conditions. Retail participants face opposite situations. Individuals purchasing small quantities have no negotiating power, no leverage to demand priority processing, and no alternatives when dealers raise premiums or extend delivery timeframes. The choice becomes accept elevated costs and extended waits or exit positions at prevailing prices. Most retail participants lack resources to take physical delivery through exchange mechanisms directly. Minimum lot sizes, warehouse storage fees, and transportation logistics make exchange delivery impractical for small quantities. Industrial consumers requiring metal for production face costs through supply disruption and elevated procurement prices, but they at least know they're dealing with physical settlement. Their challenges are visible, Procurement teams manage lead times and factor commodity costs into production planning. Financial market participants holding futures contracts often discover settlement constraints only when attempting delivery. What appeared as liquid financial instruments reveal themselves as claims on settlement systems under stress that may not honor delivery requests promptly at assumed prices. The gap between contractual terms and operational reality becomes a hidden cost borne by whoever attempts physical conversion during constrained periods. During normal conditions, fractional reserve systems work smoothly because only small percentages of claimants seek conversion. During stress, when conversion demand spikes, fractional systems can't honor all claims simultaneously. Someone must end up with cash settlement rather than physical delivery. Typically, whoever has weakest contractual protections and least leverage. The pattern of allegedly leaked institutional communications supposedly revealing panic repeats across asset classes and market cycles. The specific instruments change, but the narrative template remains constant. Secret memo leaked, institutions evacuating, retail investors being left behind, urgent action required. Historical examination reveals most of these narratives don't predict actual catastrophes. Institutions regularly adjust positions across hundreds of instruments based on evolving risk assessments. When leaked guidance gets publicized, it typically generates attention because it fits existing catastrophe narratives that audiences find compelling, not because it represents uniquely valuable intelligence. The exceptions that do precede actual market stress don't validate the broader pattern. Occasionally, institutional position reductions occur before significant dislocations, but this represents normal occurrence given that institutions adjust positions constantly. When adjustments happen to precede market stress, it gets remembered as prescient insider knowledge. When similar adjustments occur without subsequent stress, the vast majority of cases, they're forgotten as false alarms. The persistence despite poor predictive record reveals the appeal isn't accuracy, but narrative satisfaction of believing you've accessed secret institutional knowledge. The emotional resonance of being the informed insider, while others remain blind to impending disaster drives engagement more effectively than sober assessment of whether leaked guidance provides unique value. The pattern repeats because it serves psychological needs rather than informational ones, and those needs remain constant regardless of how often catastrophe predictions fail to materialize. When commodity prices show persistent differences across major trading centers beyond what logistics costs and currency fluctuations explain, several structural factors may be operating. Export restrictions can fragment global markets into regional silos with disconnected pricing. Capital controls can prevent or delay the financial flows needed to execute arbitrage trades. Political tensions can raise insurance costs for international shipments to levels that make arbitrage unprofitable, despite apparent price gaps. But the most significant factor emerges when participants lose confidence in settlement system reliability. If traders suspect that apparent arbitrage opportunities involve execution risk, that conversion from paper to physical won't occur reliably at stated prices, they reduce arbitrage activity despite wide spreads. The spread persists not because arbitrage is impossible, but because the settlement mechanisms enabling arbitrage have become sufficiently unreliable that traders require wider margins to compensate for execution risk. This dynamic reveals that price discovery has effectively split between financial markets trading claims and physical markets trading actual commodities. When these parallel systems drift apart rather than remaining linked through arbitrage, it indicates the infrastructure meant to connect them, the settlement mechanisms allowing conversion between paper and physical, has degraded beyond what standard market efficiency theories assume. The divergence isn't temporary friction. It's evidence of structural breakdown in systems designed to keep derivative prices aligned with underlying commodity values. What commodity market stress episodes reveal isn't that institutions possess unique predictive capabilities retail participants lack. It's that volatility during these periods reflects mechanical effects of position adjustments, settlement system constraints, and leverage liquidations, rather than new fundamental information about supply and demand. Understanding this distinction prevents confusing operational market mechanics with actionable investment intelligence. The sensationalized presentation of routine risk management as insider revelation generates attention and emotional response that sober portfolio management discussion doesn't trigger. The phenomenon persists, not because it reliably predicts market outcomes, but because it satisfies psychological needs around accessing exclusive information. Most institutional position guidance reflects operational concerns, rather than unique predictive insight about market direction. 3 factors indicate whether current market conditions represent temporary stress versus structural settlement crisis, whether multiple institutions simultaneously reduce positions across different asset classes, suggesting broader risk reassessment, Whether guidance aligns with observable market stress already visible in public data, and whether institutions' actual execution matches the urgency of their client communications or exceeds it in ways suggesting they're understating concerns. The solution isn't better access to institutional communications. It's recognizing that institutions adjust positions continuously for operational reasons that rarely provide useful signals about market direction. Most position guidance reflects risk management protocols designed to protect institutions from concentration risk, regulatory burden, and legal liability rather than unique intelligence about impending catastrophe. Understanding this distinction prevents confusing routine portfolio management with actionable investment intelligence, though it eliminates the psychological satisfaction of believing you've accessed secret institutional knowledge, giving you advantage over less informed participants.